Okay, everyone, here we are in our final chapter of Accounting 211, Property, Plant, and Equipment, Intangible Assets, how we determine the acquisition costs of each of those. So we're focusing on property, plant, and equipment and intangible assets, but we also mentioned that there's something called natural resources that are also a type of asset. These are all long-lived, revenue-producing assets. So they're going to be used more than a year. They're going to be used to produce revenue, but they have different characteristics, so we keep track of them differently. Property, plant, and equipment, the norms are land, buildings, equipment, machinery, furniture, and vehicles. Intangible assets, a sampling of those are patents, copyrights, trademarks, franchises, goodwill. And then you can see our natural resources. Oil and gas deposits, so you can purchase those, timber, and mineral deposits. So here's a sample note. A lot of companies will report property, plant, and equipment net on their balance sheet. So the numbers in red are the numbers that would appear on the balance sheet, but then provide a detailed note in the notes to the financial statements showing how that amount is determined. And you could see the various items that are actually involved in coming up with the net property, plant, and equipment. Here's a sampling of intangible assets for Disney Company. So they have their items. They may be on the balance sheet, or they report the net intangible asset amount and provide this as a note to the financial statements. So property, plant, and equipment, that's a lot of writing, right? We're going to go through each one though. So they're productive assets that derive their value from long-term use and operations. All expenditures, in the last column, all expenditures necessary to get the asset in condition and location for its intended use are all collected together and become the cost of that asset. So we're going to take a look at some of the typical costs with each type of asset, plant asset, or property, plant, and equipment. Equipment, that's a broad term that's used to define machinery, computers, office equipment, sometimes vehicles, furniture, and fixtures. So what's included in the cost of these types of PP&E? The purchase price, less any discounts you take or are offered. So you don't have to take the discount. Taxes you may have to pay related to the purchase. Transporting these types of items to their location. Having to pay for installation of these items, testing, trial runs, and reconditioning of them to get them ready for their intended use or their first use. So all of these expenditures related to equipment are added together, and that becomes the cost of the equipment. Land is real property used in the operations, and it's separate from assets on it because land is not depreciated. The typical type of items included in the cost of land is the purchase price. Any attorney's fees related to purchasing the land that you may have to pay. What would you pay an attorney for? Maybe they needed to look over the sale agreement. Title transfers, title insurance. Recording fees for the new title. The new owner, you're the new owner, so you may have to pay to have it recorded as such. Any sales commissions you may have to pay because you purchased this land. Back taxes from the previous owner. So any kind of real estate taxes the prior owner has not satisfied by the time you buy the land must be satisfied. If the prior owner does not want to satisfy them, you may do it when you're buying it. That becomes part of the cost of the land. Maybe mortgages you pay off to have the land, or liens you pay off that are on the land. Clearing the land, filling it, draining it, and removing old buildings. So any costs associated with clearing, filling, and draining. Now, a lot of people will say, well, that's a land improvement. Not in our book. So if you clear, move the dirt around, fill it, and drain it, that's moving dirt around. That's land. If you remove an old building, why would that be included in the cost of the land? Because when you bought the land, it was not ready for its intended use. You needed to remove the old building to get it ready for its intended use. So that becomes part of the cost of the land. Land improvements. Now, land improvements are assets that are on or in the land that will deteriorate over time, such as parking lots, driveways, private roads, sidewalks, fences, landscaping, sprinkler systems, signs, lighting, if I didn't mention it, outside. So these are items that all the costs related to paying for these things to get them ready for their first use will be part of the cost, but they're included in land improvements. Land improvements have depreciation on them. They are expensed over time because they deteriorate. Buildings. These are structures that are not only a regular building, an office building, plant facilities, warehouses. Included in this will be the purchase price of the existing building or construction, all the costs associated with construction, which we're going to talk more about interest you may pay while you're constructing a building in a little while. Attorney's fees for purchasing the building and commissions paid to a real estate agent, and any kind of major reconditioning to get it ready for its first use, all part of the cost of the building. If we're looking at natural resources, which are also put into the property, plants, and equipment category, even though they're natural resources, these are assets that are physically consumed in operations, such as trees, timber, mineral deposits, oil, and gas reserves. So what's included in the cost of the natural resource? The acquisition, exploration, development, and restoration costs. Restoration of the land to get it back to its original status after you've extracted the natural resource. Going on to intangible assets. These are assets that lack physical substance. They usually are more of a legal right the company owns. All expenditures necessary to get the asset in condition and location for its intended use are included in the costs. So patents. Patents are a 20-year right to manufacture a product or use a process. So you're the only one who could benefit from whatever the patent is on. The purchase price of buying the patent, if you should buy it. Any legal fees, whether you bought the patent or you created the invention and asked for the patent. Special filing fees. So legal fees and filing fees are usually associated with the person who applies for the patent. Any kind of research and development to invent the product that you get the patent for are expensed normally as incurred. They are not part of the patent. Copyrights, these are usually for artistic creations. Again, purchase price, legal fees, and filing fees. So if you created the book, normally you're just going to have legal fees because you're going to ask a lawyer to apply for a patent or a copyright, and then any special filing fees you may have to pay to have the copyright. But if you buy the copyright, now you're including the purchase price. Trademarks protect a slogan, symbol, or an emblem. Again, same type of costs. Franchises. It's a contractual arrangement under which a franchisor, so another company, grants the franchisee, the person who buys the franchise, the exclusive right to use the franchisor's trademark, trade name, and product rights. McDonald's, Burger King, Kentucky Fried Chicken, Dunkin' Donuts, and the list goes on. Many of these companies locally, like McDonald's for instance, I think McDonald's Corporation only owns like 3 of the actual McDonald's restaurants. I might be wrong there, but it's a very low number. all the other McDonald's in the world are owned by franchisees. So these are individual companies aside from McDonald's or individuals who have paid McDonald's, the franchisor, for the right to use McDonald's trademark, trade name, and products. So the franchise fee plus any legal fees are included in the cost of the franchise. Goodwill. We're going to look more into depth into this. It's the unique value of the company as a whole over and above all of its assets. So it's what somebody will pay for the company above the fair value of what the company's actually worth, meaning its assets minus its liabilities, the fair value of its assets minus liabilities. And we'll look at this more. So what is capitalized when it comes to property, plant, and equipment and intangible assets? There's all kinds of things. Assets can be acquired by purchasing them or self-construction. So we're going to look at purchase first, self-construction later. Donation, we'll look at that as well. Business combination, which will be looked at in advanced accounting. Exchanging them for other assets or renting them. And leasing will be talked about in intermediate accounting 3. The initial cost is always equal to the purchase price of the item plus all expenditures necessary to bring the asset to its desired condition and location for use. Again, the cost of equipment will include, so the debit in the equipment account, the purchase price of that equipment, sales tax. If the company has to pay for the equipment to be delivered to them, transportation costs they pay. If they have to pay to have it installed and tested, like for instance, if you have bought a machine that makes coffee cups, the first time you put raw materials in that machine, it's not going to spit out a perfect coffee cup. It's going to take a couple testings and readjusting of the machines. These are all costs that should be kept track of and become part of the cost of the equipment. Any legal fees to establish that you are the owner. So if you have to pay any kind of fees to do that. And any other cost to bring the asset to its condition and location for use. So we add up all of these expenditures, and this is recorded as the asset. So Central Machine Tools purchased industrial equipment to be used in its manufacturing process. The purchase price was $62,000. Central paid a freight company $1,000 to transport the equipment to its plant location, plus $300 shipping insurance. In addition, the equipment had to be installed and mounted on a special platform built specifically for the equipment at a cost of $1,200. After installation, several trial runs were made to ensure proper operation. The cost of these trials, including wasted material, was $600. Well, that doesn't matter. It was all part of getting it ready for its first use. So the $62,000 purchase price, the freight, transportation $1,000, the insurance while it was being shipped $300, the special foundation $1,200, and trial runs, add them all up, that's how much you debit the equipment for. So if we have this equipment for Symington Corporation, what's the total cost of the equipment? Add them all up. The $48,000 purchase price, the transportation cost, installation and wiring, and testing, $57,900. Let's move on to land. The costs include, again, purchase price of the land, any attorney fees in this acquisition that you have to pay for, real estate agent commissions. You may be responsible for paying a sales commission to the real estate agent. Costs related to title and title search. So a title search is when you pay someone to go to the county that the land is purchased in, to the courthouse. It's usually in the Recorder of Deeds office, and search the title to see, are there any liens on the property? Because they would be filed there. Is there anything weird on the property that we should know about? Is there any right of ways that maybe the utility company has the ability to put a road through the middle of the property? So these kind of things exist. So you want to check that all out, and you pay someone to do that. And once they find all the liens and are comfortable that they'll be satisfied when the property is sold, because a lien follows a property, not the person who originated it. Then they'll call an insurance company that provides an insurance policy, a title insurance policy. And what it means is that if in the future something was missed, a lien, or something weird with the title was not found during that process, there's an insurance policy for the new owner. And it's the insurance company that would have to satisfy whatever the problem with the title was, so that the person who currently owns it doesn't have any issues. So that's all part of the cost of the land. Recording fees, back taxes, lien, mortgages, or other obligations. Now, once you own the property, any property taxes you pay going forward are an expense. Expenditures for clearing, filling, draining the land, and removing or raising the old building. And we talked about that already. So just to review, all of those costs are included and debited to the land account. If you sell any of the materials from that building you tear down, you reduce the cost of the land for the sale price. Let's take a look. Buyer's Structural Metal Company purchased 6-acre tract of land and an existing building for $500,000. The company plans to remove the old building and construct a new office building on the site. So the land was bought with the intention of building a new office building. In addition to the purchase price, they paid title insurance of $3,000, and that's a one-time premium. So you know you don't pay that every year. Commissions of $16,000 and property taxes, which were taxed in property taxes included $4,000 of delinquent taxes paid by buyers on behalf of the seller and $2,000 for the current property taxes. Shortly after closing, buyers paid a contractor $10,000 to tear down the old building and remove it from the site, and an additional $5,000 was paid to grade the land. Now, what we mean by shortly after closing means we call it a closing when you buy the land. So the day you go and sign all the paperwork, they call that event the closing. So the purchase price of the land, including the old building, debited to the land. Title insurance, commissions, only $4,000 of the property taxes, because only $4,000 are considered delinquent. The cost of removing the old building and the cost of grading. Now, if any of that building was salvaged, say for $2,000, we would have gotten cash of $2,000. So we would have debit cash and we would credit the land account. That's how that works. But as it stands, $538,000 is the cost of the land. Land improvements, they usually have useful lives that are estimated, I can't say the word today, estimable. They're separately identified and capitalized, and they're depreciated. And we talked about the common examples: parking lots, driveways, roads, fences, sprinkler systems, lighting systems, signs. When it comes to buildings, the cost of acquiring a building usually includes the purchase price, of course, any realtor commissions and legal fees, and any reconditioning costs. Maybe you refurbish the building or remodel it, or otherwise modifying to suit the needs of the new owner. So any cost to get it ready for its first use, added to the cost of the building. Cost of natural resources, again, this includes your timber tracts, mineral deposits, and oil and gas deposits. That's what natural resources are. And benefits are derived from their physical consumption. So we include, if purchased, purchase price and the cost to get the asset ready to condition and location for use. If you're developing the natural resources, the acquisition costs, exploration costs, development costs, and restoration costs are included as part of the cost of the natural resource. All right. So those are your property, plant, and equipment assets and common expenditures related to each. So make sure you look at that really well in your book and know the difference between and know what is included. Now, the next part talks about something called an asset retirement obligation. And this is new. A company may incur obligations. When I hear the word obligations, I think liability. Something we're going to have to do. Obligation is something you have to do. Associated with the disposition, property, plant, and equipment, and natural resources. So you may have a liability in the future because of the way you have to dispose of these types of assets. This gives rise to what we call an asset retirement obligation. So an asset's retirement at the end of its life, a liability that's caused because it's done being used. This is defined as an existing legal obligation, so it's a legal obligation associated with disposition retirement of a tangible long-lived asset. So an example, oil and gas exploration company might be required to restore land to its original condition after extraction is completed. So once they're done exploring and getting all the oil and gas out of the land, they have to fill it in, grade it, make it back to what it was. GAAP requires that an existing legal obligation, so you know you're going to have this in the future, must be recognized as a liability and measured at fair value if it's reasonably estimated. So let's see what we're talking about. So there's a couple different things we have to look at. The scope, recognition, how do we measure it? So how do we recognize it? How do we measure it? And what's this present value calculation? Not again, right? Take a look. Jackson Mining Company paid $1 million for the right to explore for a coal deposit on 500 acres of land in Pennsylvania. Cost of exploring for the coal deposit totaled $800,000. Intangible development costs incurred in digging and erecting the mine shaft, $500,000. In addition, Jackson purchased a new excavation equipment for the project at a cost of $600,000. After the coal is removed for the site, the equipment will be sold. Jackson is required by its contract to restore the land to a condition suitable for recreational use after it extracts the coal. The company has provided the following 3 cash flow possibilities for the restoration costs to be paid in 3 years after extraction is complete. So the cash outflow A is $500,000 and the probability of that happening is 30%. The second option is cash flow outflow, so they'll have to pay $600,000 and the probability of having to do that is 50%. And the last possibility is a $700,000 cash payment, which would be about a 20% probability. So the company's credit adjusted risk-free interest rate, and that's what we focus on, interest rate, is 8%. So how do we calculate the obligation? Well, the first thing we're going to do is figure out, based on the probability of each, the cash flow under each circumstance. So there's a 30% chance of $500,000 that $500,000 would have to be paid. So we multiply that out, $150,000. The $600,000 option is at 50% or $300,000. The $700,000 cash outflow is at 20%. Multiply that out, $140,000. We add those all up. So the expected future restoration costs, $590,000, but that's at the end of year 3. We need to record a liability today times 0. So how much is that one-time payment in 3 years, assuming an 8% interest rate? What's its value today? So you're going to do the present value of 1, N is 3, I is 8%. Multiply that by your future value of 590. So 468, 360. So the costs of the coal deposit would be the purchase price, the exploration, the development costs, and the present value of these restoration costs. That's how much you would debit the natural resource for. And that's how we deal with asset retirement obligations. Determine how much you expect to pay at the end to restore, and then present value it back so that you can record it today as part of your asset cost. Here is your journal entry. You'll debit the coal mine for the full $2,768,360. Of that, you're only paying $2,300,000 of it today. The other $468,360 is going to happen at the end of 3 years. So you're going to credit a liability account called asset retirement liability until you have to pay that. The excavation equipment is a property, plant, and equipment. Debit that, credit cash. So that's how we handle asset retirement obligations. It's a legal right to restore the legal obligation. So you have to do it to do something with an asset when you're retiring it. Now, each year we will increase that liability for what we call accretion expense. So we calculate that by taking the asset retirement obligation times the interest rate. So whatever the balance is as of the beginning of that year times the interest rate of 8%. So at the end of year 1, you're going to debit accretion expense and credit asset retirement liability. And that will increase the amount of your retirement obligation each year until it reaches its future value. At the end of year 2, you'll take the balance as of the beginning of year 2, 505,829 times 8%, and that's how much you'll put in your journal entry. Remembering that your asset retirement obligation increases each year from this accretion expense. So that in the 3rd year, after you record your accretion expense of $43,705, your liability account asset retirement obligation will be at $590,000. What happens if the actual restoration costs are more or less than the $590,000? Well, we would recognize the difference either as a gain or a loss. So if we pay more than we thought, in this case down at the bottom, the cash is actually $625,000 at the end of the project. We thought it would only be $590,000. We'll debit the asset retirement liability for $590,000. That's what we had put away. The difference would be debited to a loss account. And the opposite would be true if the cash amount is less than the asset liability, retirement liability. That means we stored away too much. So we'll have a gain in that situation. Winterhill Mining Company paid $50 million for the right to explore and extract copper from land owned by the state of Wyoming. To obtain the rights, Winterhill agreed to restore the land to a suitable condition for other uses and its exploration extraction activities. Winterhill incurred exploration and development costs of $15 million on the project. The company's credit-adjusted risk-free interest rate is 6%. It estimates possible cash flows for restoring the land 3 years after extraction activities to begin as follows. What is the initial cost of the copper mine? So we definitely will have the $50 million and the $15 million. But then we would have to figure out the present value of these future expected cash outflows. So $5 million times 40% plus $10 million times 60%. So the expected cash outflow is $8 million. Now find the present value, 6% interest, N is 3 on that $8 million. So we know the future obligation is $8 million. But what's it worth today? $6,716,960. Add that, the total cost of the copper mine, $71,716,960. All right, so that was natural resources and that asset retirement obligation. Moving to intangible assets. Intangible assets represent exclusive rights that provide benefits to the owner. They lack physical form. It's difficult to anticipate the timing and existence of future benefits attributable to many intangible assets. Companies can either first purchase an intangible asset that's already been created, existing patents, copyrights, trademarks, or they could develop their own. So maybe they develop a new product that is patented. Some intangible assets have very defined lives. We call them finite. So we expense those assets over their useful life. But then there's other assets that have an indefinite useful lives. These are not expensed, and we'll talk in Chapter 11 in Accounting 212 what we do with these. But again, the cost of an intangible asset is the purchase price plus all other costs necessary to get the asset ready for use. So a patent, exclusive right to manufacture a product or to use a process. It's good for 20 years. It's registered with the U.S. Patent and Trademark Office, and there's our costs. We talked about those already. Copyrights. This is an exclusive right of protection for the creator of a published work. U.S. Copyright Office, and it's for the life of the creator plus 70 years. Trademarks are the rights to display a word, slogan, symbol. They're registered with the U.S. Patent Office for 10 years, and they are renewable. They're automatically renewable. And we talked about a franchise already. Exclusive right by a franchisor to franchisee to use the franchisor's trademark and product. And this is usually for a specified period of time. Goodwill. Again, this represents the unique value of a company as a whole over its identifiable tangible and intangible assets. What does that mean? Well, goodwill, this term goodwill, actually is a very intangible asset. And these are where goodwill would stem from. The clientele and reputation of the company, how well your employees are trained and your management team. A favorable business location can add to goodwill. So, goodwill can't be separated from a company. It's not possible for a buyer to just acquire goodwill without acquiring a whole company or a portion of it. So that's where goodwill usually stems out of. One company is buying an entire company. What is it? It's the acquisition price minus the fair value of the net assets. What are they? They're the fair value of all the identifiable, tangible and intangible assets. What exactly are identifiable assets? Those on your balance sheet. I'm going to sneeze. Pardon me if you heard that. Less the fair value of any liabilities of the selling company assumed. So we look and we say, what are we buying here? What assets of that company are we buying? What are the identifiable net assets? Well, all the tangible and intangible assets on that company's balance sheet. But we're not buying them at their balance sheet value. What's their fair value? What are they worth today? Subtract any liabilities we're taking on of that company. That is the fair value of the net assets. So that's what we're buying. But how much are we paying? Take a look. Smithson Corporation acquired all the outstanding common stock of Ryder Corporation for $180 million cash. Smithson assumed all of Ryder's long-term liabilities, which have a fair value of $120 million. The fair values of all the identifiable assets are receivables $50 million, inventory $70, property, plant, and equipment $90, and patent $40. So Those were appraised, and that's how much they're worth, the assets and the liabilities. So what this is saying is take that 250 in identifiable assets fair value and subtract the fair value of the liabilities. That's the fair value of the net assets, 130. So if you were just buying the assets and liabilities here, you would think a normal, reasonable person would only pay 130 million for them. But Smithson here is paying 180 million, a $50 million difference. Why would they do that? Well, there are things about companies that are very intangible, that aren't an intangible asset. They're nowhere on the balance sheet. And they're things like we were just saying, name recognition of the company, the clientele of the company, the amount of market this company has in their industry. Do people come to them to buy first? The employees, they're well trained and do a great job. The management team is awesome. They have a very favorable outlook in the public. All of these things add value to the company. And the company, if you asked Ryder, well, what are all those things worth to you? There's no value. They can't put a dollar amount on them. But Smithson just did. Smithson said they're worth $50 million because we paid $50 million more for this company than it's worth on paper. So when Smithson records this purchase, they will debit all the assets that they purchased individually. They will debit goodwill. It's Smithson that has goodwill. Credit the liabilities and credit cash. Ryder's done. Ryder doesn't exist anymore. Or Ryder, they don't have goodwill on their books. Smithson, the one who identifies it by paying more for the company than it's worth, is the one who will have goodwill as an intangible asset in their accounting records. Dearden Golf Company, a golf ball company, acquired all the outstanding common stock of Sanderson Company for $1,750,000. The book values and fair values of the assets and liabilities on the date of the purchase were as follows. Ignore the book values. They have nothing to do with this computation. They just throw them in there to try to throw you for a loop. We focus on the fair value. Current assets, property, plants, and equipment, add them together, subtract the liabilities. So the fair value of the assets would be the computation in the parentheses. Subtract $1,750,000 and the goodwill, what they paid more than the fair value of the net assets, is $165,000. So that was goodwill. What about lump sum purchases? Sometimes we purchase more than one asset for one price. Take a look. 10 identifiable delivery trucks purchased for a lump sum price of $150,000. So you bought 10 assets for $150,000. When assets have different characteristics and different useful lives, we got to separate them out. Like if these were all the same delivery truck, okay, we wouldn't have to worry about it. But what if we acquire assets that are land, building, and equipment for one price? We got to separate that price out among those three assets because they're all treated differently. Take a look. Smyrna Hand and Edge Tools Company purchased an existing factory for $2 million. The purchase price included title to the land, the factory building, the manufacturing equipment in the building, patent on a process the equipment uses, and inventories. An independent appraisal estimated the fair values of the assets if purchased separately. So that's the first thing you do. If I just bought this asset, how much would I have paid for it? So the land, you would have paid $330,000, the building $550,000, the equipment $660,000, the patent $440,000, and the inventory is $220,000. So if you bought these individually, you would have paid a total, add them all up, of $2,200,000. But because you bought them packaged together, it only cost you $2 million. So what we do is we find out, well, what percentage of the total fair value is each asset? So the land, you would take $330,000 divided by the $2,200,000. So 15% of the value is in the land. The building, you would take 550,000 divided by 2,200,000. 25% of the cost is in the building. The equipment, 660,000 divided by 2,200,000. So 30% of the value is in the equipment. And you do the same with patents and inventories. So it's this percentage of the 2 million that will be how you allocate that $2 million. So the land, 15% of $2 million, 300,000. The building, 2 million times 25%, 500,000. Equipment, 2 million times 30%, 600,000. Patent, 2 million times 20% or 400,000, and the inventories. So you've allocated what you actually paid for that based on the fair values of each one individually. So there is that allocation again. Here would be your journal entry. You're going to credit cash, and that should be on the next line down, 2 million. And then you'll debit each asset for the value you just allocated to it based on the fair value of each one individually. Land, 300,000. Building, 500,000. The equipment, 600. Patent, 400. And inventories, 200,000. So we have to do this kind of analysis and allocation anytime we purchase more than one asset for one price, especially if they have different characteristics. So here's another example. Cirrus Corporation acquired a manufacturing facility on 5 acres of land for a lump sum of $32 million. They purchased a few different assets. Each asset was appraised. The initial values of the building, land, and land improvements would be, so how much of that $32 million would be allocated to each? Well, the total fair values are 18 million, 12 million, and 10 million. Add them up. The total fair value of all these assets are 40 million. The building's fair value, or the allocation of the 32 million to the building, will be the building's fair value of 18 million divided by the total fair value of all the assets, or 45% times 32 million, 14,400,000. Do the same with the land. Land's fair value is 12 million divided by the total fair value of all the assets, 30% times 32 million, or 9.6 million. And finally, the land improvements. The fair value of those are 10 million divided by the total fair value of all the assets, 40. 25% times 32 million you paid for all three assets, so 8 million will be allocated to the land improvements. Another way of acquiring an asset is through non-cash acquisitions. So let's take a look at these. You can acquire an asset without paying cash at the time of purchase by deferring payments. So you buy it today and say, I'll pay it off $5,000 a year for the next 3 years. Providing stock instead of cash. Donated assets. So somebody gave us assets, and we can exchange them for non-monetary assets for other assets. Assets acquired in non-cash transactions are valued at the fair value of the assets given or the fair value of the asset received, whichever is more clearly evident. So that's our rule when we're dealing with non-cash acquisitions. So let's take a look at a deferred payment example. This is an obligation to make a payment in the future. So a machine acquired is acquired for $15,000, and the buyer signs a note requiring the payment of $15,000 sometime in the future, plus interest at a realistic interest rate. Well, in this case, you're buying the machine today. The price is $15. Debit machine, credit notes payable. Then in the future, when you pay it off, you'll pay off the $15,000 plus interest. But what if you have this situation? The Midwestern Steam Gas Corporation purchased industrial equipment. In payment, Midwestern signed a non-interest bearing note requiring $50,000 to be paid at the end of 2 years. They usually borrow at a 10% interest rate. Well, if that's the case, we need to know what that $50,000 is worth today, because that's how much they're buying it at. So we need to find the present value of that note. $50,000, 10% interest rate, 2 periods, the factor would be 0.82645. So they're really buying the equipment. Its cost today is $41,323, the present value of that future payment. The note would be recorded by crediting notes payable, and the difference would be interest expense. But it's not all debited to interest expense today. It's debited to the contra account, discount on notes payable. Over time, we will recognize that interest on this note. Take a look. At the end of December, the interest that's occurred on this note would be the present value of the note on day 1 times 10%, $4,132. So debit interest expense for that amount, credit the discount on notes payable. We're not paying any interest, because what happened was the value of the equipment was less on time 0, and we'll pay $50,000 at the end. At the end of December, before we pay off this loan, we'll recognize the rest of the interest, $41,323 plus the $41,32 interest we already had. So the carrying amount of the note is those two numbers added together. Multiply that by 10%. The carrying amount is basically the balance. Notes payable minus the discount on notes payable. When you credit the discount on notes payable, you just reduced the balance in that account. So the balance overall on the note or carrying value will be $41,32 higher. Multiply that by 10%. That's your interest for the second year. Once you do that, the balance in the discount on notes payable will be 0, and you'll pay off the $50,000. Midwestern, debit notes payable, and credit cash. So you can see there's the discount on notes payable is debited for the portion of that future payment that will be interest. Then as time passes, we'll recognize part of it as interest expense each year and reduce the discount on notes payable. As I said, once the note matures, the discount on notes payable should be 0, and all of that amount should have been recognized as interest expense. Take a look here. January 2nd, Dennison purchased a machine and signed a non-interest-bearing note in payment. The note requires the company to pay $100,000 in 2 years. Dennison is not sure what interest rate reflects time value of money. However, price lists indicate the machine would have been purchased for cash at a price of $79,383. So in this case, we know how much should be allocated to the machine, and we know the present value, and we know the amount of the future value, the note payable, $100,000. So the difference is interest, but we don't know what interest rate to use. Well, this brings us back to Chapter 5. We can find it. Take the present value divided by the future value. That's not the interest rate. That's the factor we will look for on the present value of one table. N equals 2. Go across the number 2 row until you reach a factor of around 0.79383, and it would be 8%. So the implicit interest rate is 8%. That's the assumption here. So we'll still debit discount on notes payable for the interest portion. On January 2nd, Edgar purchased a machine, signed a non-interest-bearing note. The note requires the company to pay $200,000 on December 31st. 2023 in 2 years. Edgar is not sure what interest rate reflects the time value of money. However, the machine would have been purchased at $120,000. So today the present value is $120,000 on this machine, the future value $200,000. The difference of $80,000 is the discount on notes payable. But the question here is, how much should they record the asset at? Well, $120,000. In the very first example we looked at, it didn't tell us what it was worth. It just said, here's what you're going to pay at the end, and you usually are charged a 10% interest rate. What if we purchase a plant asset with our own common stock? This can occur when small companies incorporate and the owner or owners contribute assets to the new corporation in exchange for ownership securities. Well, it's going to be either the fair value of the assets received by the corporation or the fair value of the stock if it's actively traded. You'll first use the market value of the shares of the stock if it's actively traded. If that's not determinable, then you'll use the fair value of the asset. March 31st, Elkhorn Company issued 10,000 shares of its no-par common stock in exchange for land. On the date of the transaction, the fair value of the common stock was $20 a share. Well then, the land value will be debited for $200,000. The fair value of the common stock. 10,000 shares times the trading price of $20 a share. Donated assets. Donation usually is an enticement to do something that benefits the donor. These are recorded at their fair values based on either an available market price or an appraisal value. Revenue is credited. Elkhorn decided to relocate its office headquarters to the city of Westmont. The city agreed to pay 20% of the $20 million cost of the building. The cost of building the headquarters in order to entice Elkhorn to relocate. It was completed on May 3rd. Here's how Elkhorn will report that donation. Debit the building for $20 million. Credit cash for the $16 million they had to pay for the building out of their own pocket. The other $4 million, 20% of $20 million, is recorded in a revenue donation of asset account, which would go on your income statement. Shackelford Corporation acquired a patent from its founder in exchange for 50,000 shares of the company's no-par common stock. On the date of the exchange, the common stock had a fair value of $22 a share. What's the cost of the patent? 50,000 shares times $22 a share, or $1,100,000. I know it says donated assets there, but this is not an example of a donated asset. Okay, this is an example of them buying an asset with stock. So you can see this was a patent. So it could be a patent, it could be an intangible, natural resource, or property, plants, and equipment. This is how we account for it. And I believe this is the end of part 1 of chapter 10. We'll be picking up with part 2 of chapter 10.